Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com comments on the TSX hitting a record high. He says it's remarkable considering oil has been going nowhere. InsideTrackTrading.com president Eric Haddock takes a look at where we are on the cycles that govern the stock markets, precious metals, and crude. Wolf Street's Wolf Richter doesn't believe the U.S. is about to tumble into a recession, at least right away, even though U.S. manufacturing, including the auto sector, has taken a hit. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Good to be with you, Jim.
The Toronto Stock Exchange closed at a record high on Friday. What's behind that? And is the TSX the hottest place to be on the planet?
Well, it's not the hottest place to be, but it has sure been a good one. You know, you take a look at it, it gave back so little in the first half of this year. You know, there was that decent run everything had up until March, April. And Toronto, the TSX, topped out around 16,600, dropped back to 16,000, that's all. And Thursday, Friday, new highs, and that's, without the aid of the oil market, which, we consider how big that is in the economy, that's holding things back. But the financials, the Shopifys, the number of items in Canada that are doing well, we're getting this nice run, and it's with a reasonably stable currency, too. Here we've got, the Canadian dollar has been stuck inside a pretty tight range for most of this year. You got about a 2.5 cent trading range, and we're dead center on it right now. So it's not as though you got a declining dollar that's making Canada more attractive internationally. It's just that there's been a nice upside bias there. And, when we take a look at the U.S. market, where we had that good bit of urgent selling at the first part of August, the 5th, 6th of August, when headlines were just about as negative as they could possibly be. You go through the stability through the rest of August and then getting some life this month. The Dow, the S&P are just running. They're correlating beautifully with a couple of the other bull markets that we look at. The 12-year run, 1949 to 1961. Market was up over 300%. The 11-year run from 62 to 73, similar big percentage move. And the style of action in the last year and a half, after now a 10-year run, is just basically an overlay of what we saw at the end of those previous runs that I just mentioned. So this consolidation phase was scheduled to go make a challenge of the highs. And we look at the Dow and the S&P, they are, with the kind of rally we had this week, they're very capable of pushing up and possibly taking out highs in the next week or so. The key is going to be follow-through. We were into that really volatile time of the year. There's been a few years where the market has continued to push right through the September-October window, but when the breaks come, historically, they can be pretty hard. So the S&P at this point, trading just over 3,000. If it breaks 2940, I think that you could be clearly wanting to go for the exit door over there.
10-year interest rates up 28%. That sounds dramatic, is it?
Oh, don't we love playing with numbers? The 10-year U.S. T-bond rate was 146 about 2 weeks ago. It's up to 140 or 188 as of the end of this week. So that's a 28% rise. Percentage-wise, big number, but just starting to retrace part of that just huge move that we saw in the rates, the decline in rates in the first part of the summer, right through until about 10 days ago. And I think we talked about this last week. The bond market in any of the high-grade items, so Treasury bonds, municipals, the high-grade corporates, all into the most overbought readings on the weekly charts that we had seen or matching the highs that we'd seen in years. Take a look at the relative strength index or the stochastic oscillators, right up to the top end of what you would ever expect. And this became just a trade that everybody was into. It was one of the safe havens out there. And as it's reversed, we've now had one of the biggest downside weeks as far as the bonds, Treasury bonds are concerned in a number of years. So we've gone from 167 on the long bond down to 157.5. Probably going to see a bounce in here because it's been a really, really hard sell-off. But the inclination is that you're going to be seeing some higher rates in that 10 to 30-year window, irrespective of what the Fed does at their next meeting, even if they drop a quarter point. The curve is starting to steepen again rather than staying flat or, the inversion that was showing up there. So steepening is probably more in the cards right now. The other thing that's happened with the strength in equities and this weakness in bonds is that the precious metals are also coming off. So all these safer havens are taking a big setback. And we had commitment of traders numbers in the speculative positions extremely high in gold and silver. Commercial positions, the short positions were extremely high. And as these markets have rolled over in the last week, we're now seeing that those positions are starting to be reduced. Now, they were large enough that the speculators who tend to use margin a little bit too much, they're going to be getting calls from their brokers, from the margin clerks, and saying, put up or shut up. Put up the money or you've got to get out of these positions. So I think that while we might be seeing a few bounces on the way down, gold, which is just under 1,500, probably going to trade down to the 1,440-ish level. Silver's at 1,750, probably works its way down under 17 in the coming weeks. So don't be in a rush to buy any of the precious metals or related companies in the short term.
Ross, thank you so much for being on This Week in Money.
Always a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Eric Haddock, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. I'm speaking with Eric Haddock, CEO and President of InsideTrackTrading.com. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim.
Eric, first of all, can you tell us a bit about InsideTrackTrading.com?
Well, Inside Track Trading is a technical and cyclical advisory service focusing on the futures market, but applying to a broad spectrum of related markets, from precious metals to energy to commodities and stocks. And we provide a variety of services and also a lot of corresponding special reports, but really trying to identify the times when different markets are poised for their bigger, more accelerated moves.
Taking a look at the stock markets, where are we in the cycle, and is this a time that people should be super aware?
Well, I probably sound like a broken record, but from a broad perspective, I still believe that 2018, 2019, and into 2020 are going to be basically a wide trading range with 1 and 2 month sharp sell-offs, and then followed by strong advances of near similar magnitude. For this entire year, I've been talking about the time frame leading into late August and looking for a sell-off into that and a bottom in late August. And when several of the markets gave some good solid sell signals in mid-July, it corroborated that, told me to look for that August sell-off, and then a bottom and a rally back to the highs from there. So we're in that phase now where the Dow and the NYSE and a couple other indexes in late August gave the first buy signals saying that the sell-off was done, and the S&P and NASDAQ 100 followed that up pretty quickly. But I think that we're going to see some more volatility on both sides. I think right now it's definitely positive into mid-September, but I could see an intermediate peak take hold around the 16th or 17th of September, and then trigger another at least a couple week sell-off. But there's a potential, depending on what happens at that rebound peak, the potential for another decent decline leading into mid-November.
Is this what I call a step-down correction in the market, where you get a 800-point drop, example, in the Dow, and then it comes back almost that high, and then it drops again? Is this going to be a pattern that repeats for the next year or two?
I think that is pretty close to what I'm describing, although depending on the index that you're looking at, it could be viewed as a step down or a step up. When you look at the NYSE index, it has still not retested its January 2018 peak. So it has been something that has been a slow angling downward type of trend, whereas the Dow Industrials and the S&P continue to spike to new highs each time there's a reactive rally after one of those sell-offs. So you have that type of divergence, which is often indicative of a larger magnitude top taking hold. I often compare it to an old wooden roller coaster where each car peaks and crosses the summit at a different time, and it's not until all the cars, till that final car sets its peak and goes over the summit, that then all of a sudden you've got that freedom for an accelerated sell-off. But until then, it is a slow, somewhat directionless type of progression that you see unfolding. And so I do think that we'll continue to see that type of progression, but with the primary indexes, they are still on a positive slant, so a bit of a step up where each subsequent high has been testing new ground.
Why have the North American markets been positive at a time when Europe and Asia are seeing negative markets? How come it can still be sustained upwards?
Well, I think there's a combination of factors, but you certainly see where the trade war and the tariffs and some of those issues have hit some of the global indexes and equities harder than they've hit the U.S. ones. I think the U.S. went into this phase, this period of time over the last year and a half in a much stronger position. So it's been able to hold up better. But if and when that final car goes over the summit and you get ready for an accelerated down move, the U.S. stocks may be the ones that see the sharpest sell-off in a limited period of time. But I still don't see that on the immediate horizon.
Are stock markets predicated on production going up, industrial production going up, and do they take into account the service sector?
Well, I think it's all of the above, but obviously you still have to take it all the way down to profits and shareholders, the shares, I should say, that even when you're looking at the trade war and the tariffs in the early going, as those price of goods start to inch up for the consumers, it doesn't seem to have as much of an impact. But then over a extended period of time, you start to see that production slow. But I think it's a combination of all of those impacting the equity markets.
We'll have more with Eric Haddock when This Week in Money returns.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Eric Haddock. Eric, what do you see happening in the precious metals market?
Precious metals have finally reached that time frame I've been talking about throughout the year, the third quarter of 2019, and in particular, one of the most uncanny and consistent and persistent web of cycles in the gold market that those cycles peaked between August 26th and September 4th. And I think that is likely ushering in a top that's going to hold for at least a couple months. But it is related to the same cycles that peaked in late February of this year and that peaked in late January of 2018. And this web of cycles that I refer to, one of those factors, a 55 to 59 week cycle, about 12 and a half to 13 and a half months. It typically averages out to 56 weeks, but that has timed every swing since the peak in August, September of 2011. And it has done it in a textbook, my cycle progression tool that I often discuss, where you saw a pair of highs in 2011 and 2012, then that cycle flips over and inverts and times 4 successive lows in 2013, 14, 15, and 16, and then from that low in December of 2016, it projected a 55 to 59 week rally, which culminated in late January 2018, and that's when you expect to start seeing that same cycle span successive highs. We saw the late February 2019 high come in exactly at that same progression. And now the midpoint of that cycle, the next phase of that comes into play in March 2020, which is when I think we'll see an even more significant top in gold. But in order to kind of reinforce and corroborate that, you look for a peak at the midpoint, which is also its own very consistent cycle, averaging about 28 weeks. And that came into play August 26th to the 30th and a little bit into the first week of September. And it even breaks down more from there. I show how this web has integrated. You've seen series of 7-week cycles, 14-week, 28-week, 56-week, and even if you look at the major moves, they break down into 112-week cycles, 2 of which spanned the decline from late 2011 into late 2015. Then there was 112 weeks from there, rebounding into where was that? The early 2018 peak, and then 112 weeks forward from that also comes into play in March of 2020. So again, as I said, it's this whole, there's all these overlapping and related cycles, but it's when you get the highest concentration of all of them that you get these significant turning points, and I think that late August, early September is another one of those that's going to hold for some time. And I have a more detailed explanation and several diagrams and charts in a couple of reports that I did that I'd be happy to send free copies to any of your listeners if they just want to contact us via email or through your site.
And can you tell people how to do that?
They can email us at admin, A-D-M-I-N, at InsideTrackTrading.com, and that's inside with the extra I in the middle. They can also send their request to inside@AOL.com, if that's a little easier to remember, INSIIDE at AOL.com, or going through our website of InsideTrackTrading.com or even 40yearcycle.com. We'll get the request through any of those sources.
We'll have more with Eric Haddock right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Eric Haddock. Eric, what's happening in the energy markets?
Energy markets, particularly crude, have been kind of confined to a range here, roughly between 50 and 60. I do think that crude is trying to put in a bottom here and should see a rally back up to that 60 level, and if it can break above that, we should see something more pronounced than we've seen this year. But I think that it's going to stay confined to a wider range, more between 50 and 70, for the foreseeable future.
The bond market, what kind of cycles is it following?
The interesting thing about interest rate futures, in particular the bonds, is that they have, since 2015, every year, right in that late August, early September time frame, you've seen an important peak followed by a substantial sell-off. Sometimes that peak was a multi-year high. Sometimes it was the second or third high in a progression before the sharpest sell-off came, but in each case, it ushered in a bearish period in September and often extending beyond that. And I was looking for the same thing coming into this year and coming into late August, early September. And it's what we're starting to see take hold in bonds, and I think that you could see this correction last into late October. But it's interesting to me, too, and I meant to point this out when we were talking about gold and following up on the stock market. But even though each of these markets don't precisely correlate to each other, it's those times when you see the biggest move where then each of those markets kind of line up with their accepted correlation. And what I mean by that is in August, we came into these cycles in the stock market that were saying we should see the sharp plunge in August into an intermediate bottom. And that was also when you saw that culminating parabolic rally in gold and the culminating rally in bonds and notes also into a peak. So you had gold and interest rate futures peaking in late August, early September. You had equity market cycles bottoming in late August. And it just showed, too, that was the real driver. It was that anxiety in the stock market is what has been driving those other markets, in particular gold. That gold has not had a close correlation to the dollar. In fact, many of the rallies in gold, including the last one in August, was occurring as the dollar was rallying. And I'm constantly fielding questions or challenges telling me there's no way that gold and dollar can rally together, since we're talking about gold priced in dollars. And yet there are as many examples of that happening as the opposite. And it just shows that the dollar gold is not the driving factor, the driving correlation. There's something else that traders are focusing on. And in mid-July to late August, that focus was the anxiety in the stock market. And the more that anxiety built, the more it benefited gold and benefited bonds as well as safe haven, flight to quality type of vehicles. But as soon as stocks start to show that they're bottoming and they're picking up some upward momentum again, then all of a sudden it's like letting some of the air out of that safe haven balloon of gold and of interest rate futures.
I was just going to ask, is there anything that truly is a safe haven, or is it just a word we use for stuff that's a bit safer?
I think that's the case, and I think that, it's probably not even a accurate assessment to call it safe haven. It's more just the thing to do of, okay, I'm pulling money out of the stock market, where do I park it for a little bit? And, the more aggressive ones go towards things like precious metals, and the more conservative ones go towards bonds. And it's also very short-lived. So, it is just a temporary parking station.
Eric, any overall advice for people in the markets right now?
I really think that it's just a case of, if you kind of dissect everything that's been said here today, it's that idea that you can't get too married to any position here in the markets, that we're in a time frame, and have been now for going on 2 years, where there's a lot of 1 to 3 month swings in both directions of the market. And it wouldn't surprise me to see that pattern continue. So you have to be a little more nimble, and unless you're just getting into something and you're willing to accept the fact that it may take a few years for a really convincing trend to take hold and to break out. So I think it's just a matter of adjusting to the circumstances and making sure you're aware of what type of market you're in.
Do you see negative interest rates coming to the U.S. and Canada?
I don't at this point, although I know there's at least one individual with a large Twitter following that is lobbying for that, and will probably continue to lobby for it even stronger and stronger as we get closer to election 2020. But I'm not so sure that's going to be the case.
Eric, thank you so much for being on the show.
Thanks for having me back, Jim.
My guest has been Eric Haddock, CEO and President of InsideTrackTrading.com. Coming up, Wolf Richter next on This Week in Money.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Wolf, welcome back to the show.
Thanks for having me back, Jim.
Wolf, new vehicle sales have been declining in Canada and the U.S., but how is the used vehicle market doing?
Now, that's interesting. We don't really have a collapse in new vehicle sales. It's in the United States, they peaked in 2016, and now they've been sort of ticking down gradually, in part because the subprime auto loans are getting tightened up after the losses are just spiking to financial crisis levels. So there's just a kind of a manageable decline. 2016 had been all-time record in terms of vehicles sold, but just barely above the previous all-time record, which was in 2000. So a long time ago, and so it's concerning because it's what keeps the industry revenues up is just price increases. Now the vehicle volume is going down, so they have to raise prices to the manufacturers to keep the revenues up. And this causes a problem because it has now made a lot of these vehicles too expensive for many people. And we're not talking about the $80,000 pickup, the crew cab, 4x4 crew cab. We're talking about vehicles that people are driving, that don't have a lot of money. And so, they're struggling to find anything they can buy. And there's a few cars out there in the market that are relatively low cost, but the average transaction price in the United States is now $36,000 US, and that's a lot of money. I just went through the median pay scales in the United States, the median household incomes. We just got that data from the census, and there's a lot of people, about 40% of them making less than $35,000 a year. Total household income, and it's tough to buy a $35,000 car with that kind of income. And these people have switched to used cars, and we see that, and we have seen that for years now. The used car market is doing very well. The used car market in the United States is far larger than the new car market, so we'll be selling about 17 million new vehicles in the United States this year. And we're on track to sell about 40 million used vehicles. So that's sales by all entities combined, so by dealers, by franchise dealers and non-franchise dealers, and by independent retailers and rental companies that sell their own cars and so forth. So 40 million cars, that's a lot of cars to sell. And there's a lot of demand for cars that are dead on the new car side. So the mid-size car and the compact car in the United States is very difficult to sell as a new car. And so the biggest customers are the rental car companies that buy them in large quantities, and then a couple of years later they sell them at auction, and dealers buy them at auction and put them on the lot as used cars. And there they compete with brand new cars that look very similar, but cost $10,000 to $15,000 more. And so the new car, the new compact car, and the new mid-size car, they're essentially just very difficult to sell. But the used cars in that category are hot. And so we have an index, the Mannheim Used Vehicle Value Index. Mannheim is the largest auction company in North America, and they have auctions all around North America. They run about 8 million vehicles through their auctions a year. And so they put a price index together on these wholesale prices of the vehicles that they run through the auctions. And a lot of the companies that use Mannheim to sell their cars are rental car companies. So they take the cars to the auction houses and have Manheim sell them to the dealers. And they have the largest volume vehicles going through the auctions are compact SUVs, mid-sized cars, and compact cars. And so there's some really good data on this. And prices on this index have now reached an all-time high. And the index is a little bit unique in that it compensates it adjusts for quality improvement. So every year, the models get better equipment and performance increases, and they get more safety features, and they get better, or maybe not better, but more complicated consumer electronics, and so these are upgrades to the vehicle models, and the price index adjusts for those. So the car may be getting more expensive, but if that price increase is just based on additional equipment, the index considers it level. So it shows a heat. It's a measure of heat in the market. And between 2011 and 2017, the index was essentially flat. And that's how it should be. It's just up and down on a seasonal basis, and for some other reason, a hurricane comes, and it goes up and it goes down. But essentially flat for this 4-year period, or 6-year period, really. And then suddenly it starts spiking. And that's when we have seen the new vehicle car sales essentially collapse. So from 2014 through 2019, new car sales. So this is cars, how they're classified in the United States have plunged by 40%. That's a huge drop. Trucks have surged, and that includes compact SUVs, which are really cars, so there's a classification error or problem there. But so trucks have surged, cars have collapsed, and on the new car side, and on the used car side, cars are really hot, and that's where they're starting to show up, and the price pressures are tremendous. And they have, earlier this year, mid-size and compact cars have 6-7% annual price increases in the auctions when they go through. So it shows a very vibrant used vehicle market, and it is fed by the overpriced vehicles on the new car side, and especially on cars. Trucks are a different matter, but cars. And dealers are very aggressive in selling used cars to make more money on a used car. Finance companies are very aggressive financing them. They can charge a little bit higher interest rates. So that's good for them. And for customers, they walk out with a lower payment and a car that looks fairly new. These rental cars that come out with 30,000 miles on them, they're in good shape and they look good. And, they will last a long time. And there's Japanese models, American models, there's some German models. So you have a fairly good choice. And the lease turn-ins are coming on the market now in very large numbers. And those span the model scale that go all the way up to the expensive luxury cars. So there's a lot of supply coming on the market, and a very powerful demand. And so whatever happens in the new car market is very important to the used vehicle market. If the rental car companies suddenly stop buying new cars, that would 2 years down the road put a supply problem in the used vehicle market. And the same with lease turn-in. Companies have been really encouraging new vehicle leases, and 2 years later these show up at the auction. So this feeds a lot of vehicles into a market where there's a lot of demand. And so right now the used vehicle market is very healthy, both from the supply side, there's lots of supply coming in, and from the demand side, with lots of demand for those lower priced used vehicles. And that's in a way that's good to see, because I used to work as a car dealer, and if the new vehicle side slows down and the used vehicle side is strong, you're still fine. You're relying on your used vehicles, and you're able to deal with the slowdown in new vehicles. It's less of a good thing for automakers. They're starting to struggle a little bit. Ford just got downgraded to junk yesterday. So it's that's where the pain will probably set in. But in terms of American consumers, they're buying cars, but they're buying them used, and there's quite a bit of demand for them. And their car as a model is not dead; it's just a new car that's dead, and the used cars are doing great.
Mm-hmm. Are people buying used pickups the same way they buy used cars?
Yeah, there used to be a problem because, people that buy new pickups, keep them for a longer time. And so they don't show up at the auction very often. And a lot of times there's a very high price on used pickups. So that's sort of in the past. And now that rental car companies have started to buy pickups, we're getting pickups and running through the auction. And there's a lot of demand for pickups. But there's also a lot of supply now coming through. And, but it used to be, a good used pickup used to be worth its weight in gold. I mean, it used to be hard to get, low mileage, good pickup. You would pay a lot of money for that. And, now it's changing somewhat with lease turn-ins, a lot of lease turn-ins, from pickups. So these are 2-year-old models. A lot of them, expensively equipped. There's a very strong market for those, and the rental car companies have them too, so they're turning them in. So it's starting to be a real factor. It didn't used to be, but it's starting to be a real factor in the market.
We'll have more with Wolf Richter when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Wolf Richter. Wolf, how are heavy truck sales doing?
This is a point of concern for us. The heavy truck makers in the United States, they've been showing record sales, but the orders have collapsed. And in July and August, they have collapsed by over 80% from July and August last year. That is a huge decline. 80% is sort of unheard of. They're now down. The orders are now down to about 10,000 orders a month for these heavy trucks. Now, these are trucks that haul the big loads we have across the interstate highways, and these are the Class 8 trucks. So these are expensive pieces of equipment, and so the orders are now down to about 10,000 a month, and the capacity is somewhere around 25,000, 30,000 a month to build them. So this is way below capacity. 10,000 a month is also below the last time we had the sort of transportation recession, which was in 2015 and 2016. So you have to go back really to the financial crisis to see those kinds of numbers. So this is a very, very sharp decline. Now, last year, 2018 was a record year for the industry, and there was a huge boom in shipping, and so trucking companies tried to buy the equipment to be able to meet that shipping demand. And now we know that a lot of that shipping demand came from front-running the expected tariffs. So companies were loading up on merchandise, and that includes a lot of industrial merchandise. And so not necessarily retail, but industrial stuff and construction materials and all kinds of stuff. And so it caused a shipment boom that everybody thought would last, but it was just short. And it was a front-running operation caused by the threats of tariffs. And so now all the inventories are full, the warehouses are full, everybody is struggling to deal with all the stuff that they have bought and have trouble selling. And so they cut back the orders for merchandise. So shipments in the United States for the last data set that we have, which was for July, were down 6% year over year. This is shipments not of commodities, but of industrial goods and so forth. And retail sales are strong, so it's not retail that's the problem. It's in the industrial and it's in the oil and gas sector where, the oil price and the gas prices are fairly low. The United States has been the largest gas producer in the world for a number of years and now turned into the largest oil producer in the world as well. So this is a huge business in the United States. And, we have another oil bust going on right now. So there's some cutbacks going on. That requires a lot of, trucking and, that industry. And so, and that pressure point has gone away too. So now the trucking companies are starting to have trouble. We had a whole slew of trucking companies so far this year go bankrupt or shut down. Most of them were small companies, but there were some fairly large regional ones that went bankrupt. So the freight rates are down. So it's really turning the entire industry around. And trucking companies have responded by cutting their orders, which is a logical thing to do. Now, these orders take many months to build. So for now, the truck manufacturers, so pack cars such as, Peterbilt and Kenworth and Mack Trucks and Volvo and all the others, they're still making the backlog that they accumulated last year. So their deliveries are still strong, but they're delivering 2019 model years right now, and the orders for the 2020 model year, they're just dead. So at some point, the backlog is going to be worked through, and then they will start to cut production. And some of them, like Navistar, already did that, and they're already laying people off. So we'll see the deliveries slow down eventually once the backlog is gone through, and then they'll have revenue warnings and all this other stuff. But this is a really very narrow and focused, but a very sharp decline. This is mostly in the industrial sector. It is, retail is good, so it's not caused by a decline in retail sales. Retails are pretty strong, but it's the industrial sector, it's manufacturing. And, so that part of the U.S. economy overall is fairly weak now. And, obviously it's weak overseas as well. I don't think manufacturing is in a recession right now in the United States, but it's getting very close. And so the truck ordering data shows us what trucking companies see in the future and how their future, meaning this year, next year, and how they're looking at demand for shipments. And shipments are already down. So this shows that there's some fairly consistent concerns about the industrial economy and manufacturing in the United States. Now, that's a fairly small part of the overall economy, but it is not doing very well.
There is some talk of a recession coming to the U.S. What does it look like to you?
Yeah, the recession talk emanates largely from the slowdown in the industrial economy, and manufacturing and those kinds of things. Now, I look at services. And services, that's 70% of GDP in the United States. And we're getting service data is a little harder to come by, but we got the second quarter data on service revenues by companies. And it's amazing how strong services are in the United States. And services, the biggest part in the United States is finance and insurance. That's 32% of all services in the United States. And, these are not low-level employees. These are well-paid people, and there's a lot of them. In terms of the overall economy, finance and insurance over 20%. So this is a huge, huge part. And that part is red hot. And as you might imagine, with all the central bank stimulus and the stock market and the bond bubble that we have, and insurance is hot. So I'll give you some numbers here. So overall finance and insurance, excluding the Fed. So the Fed, the 12 regional Federal Reserve banks are private organizations, so they're included in this. So their revenues are included in this. But I'm going to take them out because they're really not part of this. So with without the Federal Reserve banks in it, finance and insurance revenue in the second quarter grew by 7.4% compared to a year ago. That's huge. I mean, that's more than double the growth rate of the rest of the year's economy. 7.4% is just red hot growth. And, so we split that down further. And so the one category is banks and non-banks. So classic banks that take deposits and non-banks, which are lenders such as Quicken Loans and others that don't take deposits. And, their revenues grew 7%, with the shadow banks growing 8% and the regular banks growing a little less than 7%. Shadow banks are now bigger in terms of revenues than the regular commercial banks. So that's a booming sector. You know, the shadow banks are going into mortgage lending, and they're doing auto loans, and they're doing personal loans and credit cards and all kinds of other stuff. But their funding comes not from deposits, but from other sources, such as securitization and bonds and so forth. So they're not regulated by the same banking regulators that banks are regulated, so they have a little bit more leeway. Then, the brokerages and exchanges, you know, they're growing at a pretty good clip, but the biggest of the biggest is insurance related activity, insurance carriers and so forth. And their combined sales are up 8.6%, with insurance carriers up almost 10%. I mean, these are huge revenue increases, 10% for an industry. Now, you're talking the finance and insurance industry combined in the United States produce about $4 trillion in revenue. So that's per quarter. Now, that's about $16 trillion in revenues per year. It is huge. It's a gigantic industry. And it is doing really well. It's growing faster than the rest of the economy. It's growing faster than any other sector in the economy. It is already huge, so it's getting a much bigger slice of the economy. And I call this the financialization of the year's economy. And this is what we're witnessing here, is that, insurance companies and finance companies and banks, they're getting an ever larger slice of the year's economy. And it adds to GDP. It's sort of it's sort of a leech on. I mean, some finance insurance companies make many things possible, and we couldn't have a modern economy without them. But they also are an extractive industry. Yeah, they extract a lot of rent, so to speak, from the economy. And so it's not always a great thing to have, and it's not actually manufacturing anything in particular. You know, they're just, it's a service. And you know, so now we're seeing that more and more every year, more and more of the economy is finance and insurance. And that includes health insurance. So health insurance is incredibly expensive. And it includes property insurance, it includes all kinds of other insurance, and it's just a booming sector. So with the biggest sector of the year's economy being so incredibly vibrant right now, it's really hard to see a recession. Now, I'm going to go through the other parts of the major parts of the service sector. They're all strong. Yeah, the service sector overall is strong. But, of course, finance insurance is the top. Now, here's the thing. When we got the last recession, so the Great Recession or the financial crisis, what happened is that the finance and insurance sector essentially spiraled down and eventually collapsed and had to be bailed out or was bailed out. And that spiraled into the overall economy. So this is sector back then was a lot smaller than it is today. But back then even, when it started going south, the rest of the economy went south. And with somewhat of a lag. It didn't, the finance and insurance sectors, when they go south, they kind of do it quietly. You don't really notice it for a while until suddenly you notice it, and then you got a huge problem on your hands. And that's where the last recession started with. And so that's what I'm looking at. Finance and insurance, so long as they're growing at a rate of 7, 8, or 9% a year, it's very difficult for the United States to slither into a recession. It may go into a slowdown where the economy grows at a lower rate, but a recession meaning it grows, it doesn't grow, it declines, that will be tough. Now, healthcare is the second largest sector in the United States, in terms of services. It's a lot smaller than finance and insurance, but it's huge. It's close to 10% of GDP in the United States, and that is booming. Healthcare revenues, that's just services, not pharmaceutical products, which are goods, which are in a different category. So these are just healthcare services. And they're up over 5%, in the second quarter compared to a year ago. Yeah. So, that's just an unstoppable juggernaut as well. And we have a different healthcare system in the United States. It's eating everybody alive. People complain about it constantly. It is incredibly expensive to deal with, which is, in Canada you have a different system, and many of us look north sort of with a lot of envy. But that's reality in the United States. It's a huge, powerful sector, and it is thriving, and it takes out of your paycheck, but it adds to GDP, and so healthcare is very unlikely to turn down. It's not something that goes through big swings, unlike finance and manufacturing and some of the other sectors we have. Healthcare is pretty stable, and it's strong. The next biggie is professional services, and that's lawyering and accounting and architectural services, engineering, computer systems, management services, that kind of stuff, scientific and technical consulting, and that is huge. That's in the quarter, that's $500 billion in revenues, and these are highly paid jobs, and they're growing at a rate of over 4% a year right now. That is a little bit more susceptible to swings when, for example, the tech sector gets into trouble and starts laying people off. That has an impact on here. So they do go through pretty good swings. And it's a significant part of the economy, but it's roughly a quarter the size of finance and insurance. Then information technology. Okay, that includes things like digital motion pictures and broadcasting, telecommunications, your wired cell phone services, your wireless carriers, the cable systems that you have, and those kinds of things. And that is growing at a rate of 6% a year. And those are the top four. And between them, they have, over 70% of the service revenues. And they're all growing at a blistering rate. And then you go to the smaller service categories, and they're also growing, So it is, when 70% of the economy is running at a fairly hot pace, it's hard for the other 30% of the economy, to push that 70% into a recession. Now, it can happen, but it would require a fairly strong and practically a violent reaction in the goods producing sector to some kind of event, and that causes consumers to stop buying stuff, and that causes companies to stop ordering, and then it spirals out from there. But at this point, with the services being so strong, I don't see a recession in the United States. I mean, we will get a recession eventually, but right now the data says no way. There can't be a recession with services being this strong, and they're not weakening. They're not getting weaker. We don't see the slowdown. There's a little bit of slowdown in services in the fourth quarter last year, but from a very hot pace and to a slightly less hot pace, and it has picked up since. And other services data, finance insurance right now is just hot. We could have a real problem in the banking sector or somewhere else, and that will turn this industry around on a dime. But right now in the data, that's not showing up. We're not seeing it. So until services and healthcare turn around, those two biggies, I don't think we will have a recession at least until then, that we're having a slowdown in manufacturing and in industrial production. This may have gone as far as low as it will go. Maybe it looks like it's stabilizing now at a fairly low level. But, services are they're too important, and they're red hot in the United States right now.
Well, we've heard job data, depending who you talk to, unemployment in the U.S. is at record low levels. Does that tell you everybody who wants a job has one?
That's a very complicated situation. Yeah, the data, the way it is structured, pulls people out of the labor force when they're discouraged, when they don't look for jobs anymore. They may still want a job, but they stop looking for a job. So they don't count as unemployed. And they're removed from the statistics. So everybody who wants a job, that's somewhat of a tricky question, because there are lots of people out there who may want a job but who stop applying for jobs because the ageism forced them out, and nobody's going to give them the time of the day because they're too old, too old meaning almost 60 or something, and in some industries that's a death sentence. You can't find a job, or it's very difficult to find a job at that age, and if you're over 60, forget it. In some industries it may be 40, if you hit 40 you run into that problem. And they recognize that and they stop looking. And then they're pulled out of the labor force. When they're pulled out of the labor force data, then they're no longer considered unemployed. So I think there are plenty of people who would like to work, who want a job, but who see the chances of getting a job is so minimal that they've stopped chasing after it. Now, we do have a strong labor market, had one for the past few years, and it has pulled a lot of these people back into the labor force. And that is an interesting thing to watch, because these people were seeing opportunities for the first time in years and coming out of the woodwork and taking jobs. And that's one of the reasons we haven't seen a lot of pressure on wages, despite the low unemployment rate, because, there's still a lot of slack in the labor market, and it's a hidden slack. It's not right in front of your face, but you offer them enough money and you offer them an opportunity, and they come out and they take that job. And we've seen that. So I think there's still a lot of people who can still be pulled out of the shadows, and they still want a job, they still would like to work, but they for whatever reason are not actively looking anymore. On the other hand, of the people that are actively looking, it's getting pretty tight in the labor market. Companies have trouble hiring, and the thing is, they don't really have trouble hiring. They have trouble hiring at the current pay scale. That no company wants to raise its pay because it gets very expensive. So, they want to pay a certain amount, and then they have trouble finding people for that amount. But if they raise the pay, they'd have a lot of people waiting in front of the building. And so that's the thing, they're having trouble finding people at the current pay. And so if they're really desperate, they can raise their pay, and they're starting to do that. They're starting to pay, the wages are going up. And so there's enough pressure in the labor market to now do that at a rate of around a little over 3% a year. That started last year for the first time since before the financial crisis. So, there's now pressures building up in the labor market, but there's still lots of slack, and these people are coming out of the woodwork and taking these jobs. So, I think there's more there's more room to run. I'd like to see, I'd like to see more people get pulled into the labor force.
Wolf, thank you so much for chatting with us.
Thank you, Jim.
And before we go, can you tell people a little bit about Wolf Street?
Yes, wolfstreet.com. Everything is free. It's just business, finance, and economics. We stay out of politics mostly. And we have a vibrant commenting section, well-behaved commenting section, and very interesting commenters. A lot of times, a couple of hundred comments, some of them very long. So come by wolfstreet.com and make sure you read the comments.
Thanks again, Wolf.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Haddock, and Wolf Richter. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on howstreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Always good to be here, Jim.
Larry, I know you've always got something cooking down at American Manganese. What's the latest?
Well, we hope to have a press release out this week, but, it certainly will be next week, and that's just part of the progress that's being made. What I really keep a close eye on is what's happening in the recycling market and who's getting involved, and I've come across some interesting things that I want to talk about today. And one is that there was a press release that came out that the three major companies in the European Union, Aramet, BASF, and Suez, partnered to develop an innovative closed-loop process for the recycling of lithium-ion batteries. And I like this part, responding to the strong growth of the market in the coming years, and certainly we've been seeing that. And they've been awarded 4.7 million euros to get that kicked off, and it'll be probably starting in 2020. And but the reason I say, I don't shiver when anybody comes in as competition, because we have patents that protect our process. If somebody can come up with something better, well, there's going to be lots of room for many, 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 many players out there as time goes by. But also, to get attention to our own recycling story, I mean, we've been all over the world, and we get responses from all over the world. It's not like we're unknown. But we're in a phase, and that phase is that we're in kind of like the development and feasibility stage. Now, we've just about completed the pilot plant work, and we'll be able to start working on third-party submissions, mostly from battery manufacturers and or battery and EV manufacturers. So that puts us into another ballpark. Now, what I'd like to say, just going back to the previous talk of the three major companies, was finally talking about a budget on what they're going to spend the money on for recycling. You've seen a lot of talk by companies that are saying they're going to recycle batteries. They don't have a budget. They don't have a timeline. They just have just state like, just like getting up in the morning and just saying, well, I'm going to recycle batteries today, and we'll build a plant in a couple of years. Doesn't happen that way. And so it's pleasant for me to see that there's actually a budget in this latest release, which tells me that something is going to happen going forward. And seeing as you're using government money, it'll definitely mean that things will go ahead. And what's that do? That attracts attention to recycling. They'll be talking about recycling. Other people will be talking about recycling, and we won't be the only one out there pushing the envelope. And that usually reflects in the market, because people start doing due diligence on what's out there, what's available. And I've seen this happen on several occasions over the years, especially in molybdenum when we were the only one there. And then the market cap within 3 years had gone from a $5 million market cap to a $300 million market cap. And that's what excites me about these new players that are coming on the board. But there's also an interesting article in Visual, and I'm just trying to remember the name of that group. They put out a visualization every day on what's happening in the market, and they visualize the life cycle of a mineral discovery. And that's interesting because if you follow along, and I've attached this to this podcast, if you look at the life cycle, you'll see that, there's a concept and pre-discovery period of 4 to 5 years. And we've just gone through that. We've had a concept, and we've had everything in about 3.5 years is what's taken us to get to that point. And then they have the discovery period, which we've gone past already, and then they come into the feasibility stage, which we will be through in 2 or 3 months because we don't have to go through everything that they have to do to show the feasibility of this project. And then as you enter the development stage, is when the market takes a big run, and then it tails off during the actual production stage. But I'd like people to take a look at that because you're looking at 10 to 12 years for this to happen. And I think we're looking at less than 5 years to actually have some production coming online. So that's really important because there's a lot of articles, and the most recent one I read was where actually this article said that the cheapest way to get the cathode materials was to go out and mine them. And that's not exactly the case. I mean, if you look at this timeline, you'll see that it's fraught with risk, and we've pretty much de-risked our project. We have 2 patents. We have a patent pending after this final work that we're doing right now, and then we can move into the actual feasibility and development stage, which will not take that long. We don't have to do resource studies and all that sort of a thing. But it just shows that the curve is just perfect for us. I think we're coming into an area where everything is going to start to come together for the company. It hasn't been an easy road. We've spent over $6 million, $6 to $7 million on development of this project. And there's no shortcuts to doing that. So, people have to remember that we protected our technology by patenting it. And the interesting thing is we got our patents through in 13 months and 4.5 months, and which tells you that nobody was on the same game page as we were. And so that really makes me feel very confident that we have an answer here that can solve the problems of lithium-ion batteries, specifically in the electric vehicle stage. And that's where the big bulk of the batteries go. And so that's a big part of the message today. And I'm just going to say that we had on our letter from the Economic Standard, we're up to 19,000 openings now. The last letter, and of course this letter is on the super royalty reform, which would hand China a lot more than rare earths for leverage. And the first letter was on rare earths, or just the beginning, and how the U.S. can break China's metal grip to foster innovation. So, and that one had 82,000 openings while it was up. So we're happy with the response that we're getting. And these articles are done by myself and on behalf of American Manganese, Inc. So it's also exposing the company to, in this so far, over 100,000 new readers. So we have, that's been a big success, and I think you'll see some of that reflected in the market. So, all I can say, Jim, is that next week's another week, and hopefully we'll be getting a little closer to designing the plant and complete the feasibility study
And right now, it's not going to change much from the initial feasibility we looked at. But you have to remember that we have taken a little longer with this study because as we moved through the process, we saw ways to reduce costs. And that's going to be really important going forward, especially if you have competition and you want to have that those areas patented as well as the initial patented. And so we're happy with the progress so far, Jim.
Larry, for people who are new to American Manganese, what are you all about?
American Manganese is a critical metal company that's developed a process and patented it in 4 countries for the treatment of very low grades of manganese to produce electrolytic manganese metal and electrolytic manganese dioxide. Metal for specific uses and dioxide for batteries. And we were able to do that at a similar cost at that time to what China was paying to develop the same products. So, and they were using grades that were 20 times higher than ours. So that's a big plus. And we took that technology and we developed a technology around that allows us to actually recycle the lithium-ion cathode materials out of the existing EV batteries, and that's our major focus right now. You can get all this information at our website, AmericanManganeseInc.com. You can follow us on the market at on the Toronto Venture Exchange, AMY, on the U.S. Exchange, AMYZF, or in Europe under the symbol 2AM. You can always contact the company by phoning the company at 778-574-4444, or you can email me at lreaugh, L-R-E-A-U-G-H, at amymn.com.
Larry, thank you so much for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on September 13th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Company Showcase is a production of How Street Media Incorporated.